Holy smokes everyone, boy it was another wild day in the markets, but in today's video I'm going to go over specifically what the Federal Reserve just said and some hints and some gems that they've let us know what they're going to do with interest rates, with asset purchases and with their balance sheet, and what this is going to lead to in the markets and in the economy and inflation in 2022. So everyone, I watched his full press conference and I sat through the painful 1 hour Q&A and I noted down the most significant things he said and some key insights to what could be coming ahead with the Federal Reserve, with interest rates. So let's not waste any time. I'm going to give you a full breakdown of what the Federal Reserve said and how the markets reacted to this. Because people, he said, now is very different than last time they started lifting interest rates in 2018. Okay, let's have a look. Okay, so as we can see here, the Federal Reserve points to interest rate hikes as expected in March. But this is what I'm going to get into, the full recap of the Federal Reserve's press conference. Okay, so first things first, the market was wondering what the Federal Reserve is going to do with its current asset purchases of US Treasuries and mortgage-backed securities. The Federal Reserve announced they're going to reduce their purchases to just $30 billion in February. And really, again, people, I don't know what they're waiting for. They agree inflation is out of control, but they're still just tiptoeing because they don't want to crash the markets. But they did say they're going to completely stop asset purchases in March. And I'll bring up a chart here, everyone. As we can see, as they announced this, yield spiked from 1.78% all the way up to 1.87%. Now, Jerome Powell was asked if he will lift interest rates in March. He didn't say it's definitely going to happen in March, but he gave a very strong hint that is almost certain they will start lifting interest rates in March. But the question everybody was wanting to know is, how much will they lift interest rates? Will they just do a 0.25% interest rate hike, or will they do a full half percentage point interest rate hike? He was asked this in a press conference, and obviously he can't say whether he will or not, but he didn't rule it out, and he says if things change, they will use their tools to fight inflation. Now, also another great question he was asked is, how long will he be lifting interest rates for, and what will he do if interest rates going up hurts the job market? And he had a very interesting response, and this had a big reaction to the markets because remember, at the start of the day, all the markets were up over 2%, so we saw massive swings here as he was talking. Something very interesting. He said the labor market is so strong, they have huge amounts of room to lift interest rates. They've got plenty of room to lift interest rates before it starts hurting the jobs market. And why this is good for the jobs market and the economy, and that sent shivers down the market spine, because then that means there could be more than 4 rate hikes this year. Also, another great question he was asked, what is the biggest risk of all right now? And what he said was the biggest risk is if inflation doesn't go down and they have to lift interest rates much more than they expected. He also admitted that supply chains aren't going to be fixed in 2022. They're going to last until 2023. He also said another big risk is the pandemic isn't over, and this is going to cause a short, sharp reduction in economic activity. But the elephant in the room and what everybody wanted to know was, what did he think about the current sell-off that's going on in the NASDAQ, the S&P 500 and the Dow Jones, with the NASDAQ down around 15% and the S&P 500 entering into correction territory? Because in 2020 and 2021, Jerome Powell was there to save the day and to talk up the markets every time it went down. But this was his response. He says, our focus is on the economy and our focus is on price stability. So really their goal is full employment and stable prices. He said, asset prices falling doesn't bother the Fed as long as it doesn't affect their two goals of full employment and price stability. But one of the biggest takeaways we got out of this meeting was he was asked about the last rate hike cycle in 2018 that caused the S&P 500 to fall 20%. Now, during that time, they had to lift interest rates up to 2%. But he said this time, inflation is much worse than then. Back then, inflation was only around 2%. And he says the economy is much stronger, so they're going to have to lift interest rates more than last time. So all these people saying that they're only going to lift interest rates 4 times, that's not going to cut it. They're going to have to get interest rates up to 3 or 4%, people, if they're really serious about fighting this inflation. Now, also another huge question, he was asked about his balance sheet, because remember, the Federal Reserve balance sheet has gone from 4 trillion to what it was in 2018 to nearly 9 trillion, over doubling in size. And what Jerome Powell admitted during this press conference is he said the balance sheet is too big, and quote, he's going to have to reduce the balance sheet significantly. So I think this is why the treasury market is shaking in their boots and yields are spiking so much right now. Because if they're selling off US treasuries, then that means bond prices are going to fall and yields are going to go up. He was asked when and how much this would happen. Now, we didn't give a specific time, but he kind of hinted it would happen in May or June after they've done a couple of rate hikes, and Goldman Sachs expects that they will do this at a rate of $100 billion per month. Now, the next key date is February 10th when we get the next CPI data. And if inflation doesn't go down, you can expect more pain in the markets. And if it's lower than expected, then we may see a rally. But like I've been talking about, it's not just the Federal Reserve that is causing this stock market crash right now. We have valuations that are simply too high, with price to earnings ratio on the Shiller PE index over 30 at 37, and the last 4 times it's gone over 30, the S&P 500 has plunged 20%. We also have no more stimulus, consumers in record amount of debt, saving rates are plummeting, consumer sentiment and consumer confidence is falling. So again, this means even without the Federal Reserve lifting interest rates, the stock market has to correct to come back down to fair value. So it looks like the Federal Reserve isn't going to be there to save the day for all these dip buys. What this also means is we're going to see huge amounts of volatility. But what we are seeing is the stock market is falling day after day after day. And every time there's a rally, there's a sell-off just around the corner. It's not going to be a straight decline to the bottom. It's going to be a bumpy ride. So buckle up, everyone. Now, for all my loyal viewers and subscribers still watching, you're awesome. That was a quick update with what the Federal Reserve said. What do you think about this? Let me know.